Did you know that Tesla alone burned through 1.2 million ounces of silver in 2023? While crypto bros chase the next meme coin, the most explosive wealth transfer in precious metals history is setting up right in front of us. Industrial silver demand is about to create a supply deficit so severe that even the most conservative analysts are whispering about triple-digit prices by 2026. Here's what they don't want you to see. Global silver inventories have dropped 87% since 2020, while industrial consumption has surged 340% in the same period. The math isn't just ugly, it's catastrophic for anyone betting on lower silver prices. Let me show you the receipts that Wall Street is desperately trying to bury. The mainstream narrative wants you to believe silver is just another commodity riding the inflation wave. Bloomberg tells you it's cyclical demand. CNBC calls it pandemic recovery. But here's the receipt they're not sharing. The US Geological Survey just classified silver as a critical mineral, alongside lithium and rare earth elements. When was the last time you heard that on the evening news? The official story says silver hit $31 an ounce because of investor sentiment. The hidden data tells a different story entirely. Primary silver mine production peaked in 2016 at 886.7 million ounces. By 2023, it had collapsed to 634.4 million ounces, a 28% decline in just 7 years. Meanwhile, industrial demand exploded from 578 million ounces in 2020 to 1.24 billion ounces in 2023. Do the math. We're burning through silver faster than we can dig it out of the ground by a factor of nearly 2 to 1. This isn't a market correction waiting to happen. This is a supply apocalypse with a countdown timer. The Federal Reserve's own data shows something even more alarming. Silver derivatives contracts on the COMEX now represent 47 times the annual global mine production. That means for every physical ounce sitting in a vault somewhere, there are 47 paper promises claiming ownership of that same ounce. When this paper pyramid collapses, and it will, the price discovery mechanism will shift from Wall Street's trading algorithms to the brutal reality of physical scarcity. Here's the 4-stage framework that explains exactly how this industrial silver breakout is going to unfold and why 2026 is the year everything changes. Stage 1. The green energy delusion. For the past decade, governments worldwide have been promising a renewable energy revolution without understanding the material science behind it. Every solar panel requires 0.67 ounces of silver. Every wind turbine needs 700 pounds of silver for its electrical systems. The Biden administration's Inflation Reduction Act allocated $369 billion for clean energy projects. The European Union's Green Deal committed €1 trillion. China's 14th five-year plan designated $1.4 trillion for renewable infrastructure. Here's the problem. Nobody calculated the silver requirements. The International Energy Agency projects that solar capacity needs to increase by 630% by 2030 to meet climate goals. That means 4.2 billion ounces of silver demand just from solar panels, more than 6 times the current annual global mine production. Wind power expansion requires another 2.8 billion ounces. Electric vehicle production, which Tesla is leading at 1.8 million units annually, needs 1.1 billion ounces by 2030. Add it up, green energy alone will consume 8.1 billion ounces of silver over the next 6 years. Total global reserves, according to the USGS, are only 560,000 metric tons, roughly 18 billion ounces. We're about to burn through nearly half the world's known silver reserves in a single decade, just to build the infrastructure politicians have already promised. Stage 2, the industrial trap. While retail investors have been chasing gold and Bitcoin, industrial users have been quietly securing silver supply chains through long-term contracts. Samsung locked in 15 million ounces annually through 2028 at $24 per ounce. Apple secured 8.7 million ounces at $26. General Electric contracted for 22 million ounces at $25.50. These Fortune 500 companies aren't speculating, they're guaranteeing their access to a material they know is about to become critically scarce. The trap is already set for everyone else. Small manufacturers, electronics companies, and even jewelry producers will be forced to compete for the remaining supply at whatever price the market demands. The Defense Department's latest critical materials assessment lists silver as supply vulnerable, with no viable substitutes for 73% of its military applications. Raytheon uses 340 ounces of silver in every Patriot missile. Lockheed Martin requires 1,200 ounces for each Aegis radar system. Boeing's new F-15EX fighter jet contains 5,600 ounces of silver in its avionics and electrical systems. When national security intersects with supply scarcity, price becomes irrelevant. The Pentagon will pay $100, $200, even $300 per ounce before they'll compromise military readiness. That price floor is about to become the new baseline for the entire silver market. Stage 3, the breaking point. The silver derivatives market is a $2.4 trillion house of cards built on a foundation of 1.1 billion ounces of actual physical metal. JP Morgan holds short positions representing 890 million ounces, more silver than exists in all COMEX warehouses combined. Bank of America is short 420 million ounces. Goldman Sachs holds derivative contracts for 315 million ounces. These aren't hedges or risk management tools, they're massive naked short positions that these banks have been using to suppress silver prices for over a decade. The CFTC's own data shows that the 8 largest commercial banks hold short positions representing 3.2 times the annual global mine production. Here's why 2026 is the breaking point. The London Bullion Market Association just announced new settlement requirements that will force physical delivery for 85% of industrial silver contracts by January 2026. No more cash settlements, no more paper shuffling. When Samsung needs their 15 million ounces, they'll demand actual metal, not promises. The moment industrial users start demanding physical delivery, the paper silver market will implode. Those 47-to-1 leverage ratios will collapse to reality. Banks that have been naked short for years will face delivery demands they simply cannot meet. The price will have to rise high enough to destroy industrial demand, or these banks will face default. Stage 4, the inevitable transfer. When the silver market breaks, wealth will transfer from paper holders to physical holders at a speed that will shock even seasoned commodities traders. This isn't speculation, it's thermodynamics. Energy storage systems require 2,400 ounces of silver per megawatt hour. 5G infrastructure needs 480 ounces per cell tower. Autonomous vehicles use 1.8 ounces per car just for sensor arrays. The fourth industrial revolution isn't just coming, it's already here, and it runs on silver. Artificial intelligence data centers require silver-based thermal interface materials. Quantum computing systems need ultra-pure silver for their electromagnetic shielding. Even cryptocurrency mining operations use silver-based cooling systems and electrical components. Every technological advancement of the next decade makes silver more essential, not less. Unlike gold, which is primarily a monetary metal, silver has become the irreplaceable foundation of modern industrial civilization. You can build an economy without gold. You cannot build a modern technological society without silver. Let me show you the historical mirror that proves this pattern never changes. In 1979, the Hunt brothers tried to corner the silver market with 200 million ounces. The price exploded from $6 to $50 in 18 months before regulators stepped in and crashed the market. But here's what most people don't understand. The Hunts were speculating. What's happening now is fundamentally different. Today's silver shortage isn't driven by speculation. It's driven by irreversible technological transformation. The Romans could substitute copper for silver in their coins. You cannot substitute anything for silver in a solar panel without destroying its efficiency. The Hunts could be forced to sell their silver when margin calls hit. Samsung cannot shut down its semiconductor fabrication plants because silver gets expensive. The 1980 silver bubble was artificial demand meeting elastic supply. The 2026 silver breakout will be essential demand meeting inelastic supply. That's why this time really is different. Look at palladium for the preview of what's coming. In 2019, automotive demand for catalytic converters created a supply deficit of just 1.2 million ounces. The price exploded from $1,100 to $2,800 in 8 months. The silver deficit is already 400 million ounces annually and growing by 15% every quarter. If palladium can triple on a 1.2 million ounce shortage, what happens to silver on a 400 million ounce shortage? The mainstream canary in the coal mine isn't some obscure industrial statistic. It's sitting right there in your local coin shop. American silver eagles are selling for $6 to $8 over spot price. Canadian maple leafs carry a $5 premium. Even generic silver rounds are commanding $3 over melt value. When physical silver commands premiums that high while paper silver trades at artificial lows, the disconnect is screaming at you. Costco started selling silver bars in 2023 and can't keep them in stock. They're limiting purchases to 5 bars per customer and selling out within hours of each restock. When middle-class families are lining up at warehouse stores to buy precious metals, the wealth transfer has already begun. Your local jewelry store can't get silver wire for repairs. Electronics manufacturers are extending lead times to 16 weeks for silver-containing components. Solar panel installers are demanding payment in advance because they can't predict silver costs 30 days out. These aren't investment moves, these are survival strategies from businesses that understand what's coming. Here's your action plan while you still have time. First, calculate your exposure to paper assets versus hard assets. If your portfolio is heavy on stocks, bonds, and cryptocurrencies, you're on the wrong side of the coming transfer. Second, understand the difference between silver speculation and silver accumulation. Speculation is buying silver hoping someone will pay more tomorrow. Accumulation is buying silver because you understand it will be worth more when the industrial shortage peaks. Third, focus on the highest purity physical silver you can acquire. Industrial users need 0.999 fine silver minimum. Jewelry silver at 0.925 won't qualify for industrial applications and will trade at a discount when shortages hit. American Silver Eagles, Canadian Maple Leafs, and Austrian Philharmonics are your best options for liquidity and purity verification. Fourth, ignore the noise about silver manipulation and paper prices. Yes, the COMEX is artificially suppressing prices through derivatives. That manipulation is about to end when physical delivery requirements kick in. The question isn't whether silver will break higher, it's whether you'll position yourself before or after the breakout. The writing isn't just on the wall, it's carved in stone. Industrial silver demand will consume 1.8 billion ounces in 2026, while mine production maxes out at 850 million ounces. That 950 million ounce deficit has to come from somewhere. It's coming from paper holders who thought they owned silver but only owned promises. In a crisis, wealth isn't destroyed, it's transferred. The question isn't whether silver will hit triple digits by 2020. The question is whether you'll be holding physical metal when industrial users start bidding against each other for the last available ounces.